Hello everybody and welcome to the Tortoise channel. Today's video is on the latest annual report that was released by Fundsmith Equity Fund. For those of you who don't know this fund, they are based here in the UK, and they've had a very good track record going back to their inception in on November the 1st, 2010. And for that reason, I just want to break down the main highlights from this report. Okay, so stay with me for the next couple of minutes as I will walk you through everything you need to know. So you can see that since November 2010, the Fundsmith fund has delivered about 13.8% annualized returns. On the flip side, this return has actually come under pressure over the last few years, and they have actually been underperforming the overall market for quite a few years now. And the reason for that is because a lot of the gains that the S&P, for example, has delivered over the last few years, as you guys know, have been on the back of the Max 7 stocks, right? So these holdings have driven the majority of the S&P 500 returns, but they have also contributed the most in terms of earnings, right? In terms of earnings power. So it's not like they are not profitable at all. So no, it's nothing like that. But unless you own some of these companies throughout that period, then chances are that you would have either underperformed or just match the S&P returns. Or you, of course, focused on another strategy, and that has been my case, for example, in all the investors that I know, because my main criticism to Fundsmith is that I think he overpays for companies. So he's what's called a quality investor. He really buys high quality companies. I just think he overpays for them. So but we will talk more about that as well. Okay, so the report is about 17 pages long, which is quite extensive. However, as always, I just summarized everything in a Word document that you guys will find right now. Okay, and then I will just switch between the PDF that I have here and the Word document, because I want you guys to see the graphs that they have that they have alluded to. Okay, so number one, the main highlight is that underperformance is explained, not excused, and so he does not expect to outperform every single year, as he says that in the shareholder letter. And 2025 was another challenging period. So he stresses this as an explanation, not as an excuse. Transparency matters. Why is he saying this? Because he has been the target of a lot of criticism, and they say that the fund is making excuses. Okay, and it's just an excuse for the underperformance. But he says, look, what I'm presenting here is an explanation, and then you decide whether it's an excuse or not. It's not an excuse. This is just an explanation based on our understanding of the markets and where we are right now. So here we go. Okay. So he points in the shareholder letter to three main headwinds. Okay, and these have been the root cause of that long year underperformance. Number one, extreme market concentration, Magnificent Seven. And of course, I've already alluded to this in some of my previous videos. So just go back to them and you will see that I completely agree with him on this topic. Extreme market concentration. You can see that the small group of mega cap tech stocks, the so-called Magnificent Seven, dominated market returns. Sure enough, what does he say? He say that by end 2025, top 10 stocks accounted for 40% of the S&P 500 and generated about 50% of the total index returns. Okay, last time the US market was this concentrated, you had to go back all the way to 1930. Okay, so history shows such concentration often leads to long periods of weak returns after bubbles. Guys, you have to pay attention to this. Okay, so you have the example of the 30s, the dot-com bubble in the 2000s, and then also the Japan in 1980s. And in the case of Japan, it took them only recently, and by recently I mean 2024, if they finally broken even, it finally broke even, which is staggering. Okay, so what's his stance? Even if some of these companies are good businesses, owning all of them at index weightings would be reckless portfolio risk. The fund is a portfolio, not a bet on one sector or team. Okay, let's go now back here to the annual report. You can see where he points out to where he discusses index concentration at length, and then look what he has here. You can see concentration of performance from top 10 stocks in the S&P. This is exactly what it means. So you can see that in 2020, look at 2024, right? So you have about 34%, right? This is the percentage weighting in the S&P 500 of the top 10 stocks. That's about 34%. And the percentage of overall S&P return right now stands at about 63%, which is staggering. 2024. Okay. And now look at this. Look at the US market concentration over the last 125 years. So concentration of the largest 10 stocks is at the highest level in history. Okay, so you can see where he says that although this is regatta didn't regain exactly, the US was okay, so this second chart shows that the last time the US market value was this concentrated was in 1930. What happened next? Look at that, 1930. You can see that the markets just plummeted, right? And it took until 1954 for the S&P to regain its 1930 high. Okay, although this is regarded as prehistoric by most investors today, it is wise to remember that the S&P, not the Nasdaq, did not regain its 2000 high until 2007, and then promptly lost it again in the credit crisis until 2013. Okay, when bubbles burst, they can cause many lost years or even decades, and this is why I consistently pound the table on this. Don't fall into recency bias. If you don't know what recency bias is, just watch one of my videos on cognitive biases that stop us from achieving better than average returns. And one of them is recency bias. And sure enough, I have many people, okay, that come to me, hey Ed, I mean 15% annualized returns, come on. Over the last 15 years, the S&P has delivered 15%, so we didn't have to do anything. But they are assuming that the next 15 years are going to deliver the same returns, which is wrong. Wrong, wrong, wrong. In fact, I showed you here in on this channel that so if I go right here, you can see that JP Morgan, for example, is predicting quite muted returns going forward. Where is that? Market concentration and valuation. And you can see, where is this? Right here. No, sorry, excuse me. This is a good one as well, but I want you guys to focus on this. Here we go. Look at that. So according to JP Morgan, when the forward PE is at these levels, the subsequent 5-year annualized returns are around zero. Okay, zero. So they project the next 5 years to deliver about zero returns for the S&P 500. Take that into account, please. Okay, let's continue. The second point he highlights is the growth of assets in index funds. What are the main findings right here? He says that index funds are fueling momentum, not fundamentals. Over 50% of US equity assets are owned in index funds. So index funds buy stocks purely based on market value, not quality or valuation. Function as a momentum strategy, not passive investing. So whenever you guys say, oh, but the S&P has 500 companies, when I buy the S&P, I'm quite diversified. Wait, hold on, not exactly, because actually the biggest chunk of your capital is going towards the big 7 companies because they are the largest by market cap. Okay, it's a market cap weighted index. Take that into account. Look at that. About 70% of the S&P trackers now flow into Nvidia and 35% into the Magnificent Seven, regardless of valuation. Whenever you guys are buying the S&P, you are buying these overhyped, over-owned stocks that are many of which are trading at nosebleed valuation levels. Okay, and this leads, it's like a self-perpetuating cycle, because this leads more people to buy into the index, which on the other hand continues to drive the market cap higher. And it's how it works. Very, very risky, if you ask me. And so the inelastic markets problem, research from the NBER shows that $1 flowing into the markets can move prices by about 5.50 dollars due to forced buying. Okay, this creates dangerous distortions, pushing prices far beyond fundamentals. In valuations like Tesla, for example, at 327 times earnings, become unavoidable risks for active managers who don't own them. Okay, so yeah, I mean, if you think you are safe buying into the S&P 500, just don't forget, as I will show you right here in this chart that I often present to my clients, and they are like, "Oh my God, is this even possible?" Yes, guys, just go back and check. Actually, try to understand history. Look at that. For many years, the S&P did nothing for several years. So watch out. Okay. And so, key warning right here: index investing X scale risks becoming self-reinforcing and destabilizing, misallocating capital across the economy. Okay, because people who are buying indexes, do you think they know what they're doing? No. So when I tell them about the waiting risk, they say, "Oh, really? Yes, yes, of course." And so they have no idea what the fundamentals are. They don't even know what the P's are and all of that. They don't know. They're just buying because they believe the index over time is going to continue to go up. Now, I think over the next 30 to 40 years, chances are that your annualized returns will be around 9-10%, which has been the average for the last 17 years. But you assume you're going to get 17% is ludicrous. Okay, so this time is difference is always a dangerous belief. And he points out to Sir John Templeton right here. Where is that? Sir John Templeton, who founded the eponymous investment management group, once said, "The four most dangerous words in investing are 'this time is different.'" Okay? And that's what we are discussing right here. Fundsmith compares today's AI boom to dot-com bubble, Japan in the late 80s. High valuations do not reduce to the true cost of capital. Long-term equity returns are about 9%, not 2 to 3% implied by extreme PEs. Overinvestment during valuation booms often leads to what? Poor capital allocation, value destruction, years of weak returns. Okay? Important nuance here is that AI may transform society, as it points out, but doesn't guarantee attractive investment returns. So the key question is, who captures the profits, not who builds the infrastructure. Look what he says here. Okay. Let's see. Let's see where he says that equities, they should demand costs. So this is where he talks about the costs. Okay, so we've seen this before, not only in the dot-com boom and bust, but in other examples, such as Japanese market in the late 80s. Then we were told that the P of over 50 on the Nikkei index was okay because Japanese accounting was conservative. In fact, the market was just overvalued. After the subsequent fall, it took until 2024, as I already said, for the index to regain the peak it attained in 1989. Okay, so when we are always trying to create narratives around higher prices, okay, there is always an explanation, but we know deep down when things are just out of whack. Okay, so it's important again to leave our emotions aside and stay and stick with fundamentals and try to be pragmatic in this in pragmatic and realistic. Okay, realistic. Do you think a PE of 50 for an index is realistic? I mean, come on, guys. I mean, come on. I mean, you are definitely completely caught up in this bubble here if you think that is the case. Okay, so yeah, this is what's important. And now another key reason for the underperformance has been the dollar weakness, which hurts returns for UK investors. And here he mentions that, for example, UK USD weakened from 1.25 to 1.35 versus GBP. And since most portfolio companies, so most companies in his portfolio are US listed, they earn a large share of revenues in US. Okay, so GBP returns suffered even if business performance was solid, and that is the case. Now, what you won't do, you won't, uh, so you won't concede, you won't succumb to pressure by from analysts, from shareholders. He says that they will not buy stocks just because they dominate the index. So many people may ask, hey, why are you not owning Tesla? Look how far they've gone. Because we are not just buying stocks for the sake of it. No, we actually apply a framework that allows us to select what we call quality at reasonable prices. So we won't buy stocks just because they dominate the index. Become momentum investors chasing price action. So if you want an index fund or momentum strategy, you can buy those cheaply elsewhere. Okay. Now, what they will do is stick to their core philosophy, which revolves around what? Buying high quality companies with predictable growth, strong returns on capital, long-term free cash flow generation, and then continue refining ideas following Charlie Munger's principle. Any here you don't destroy one of your best love ideas is probably a wasted year. Okay, so this is the dollar, the USD versus GBP exchange rate, as you can see, and and now you can see, and now he then moves on to talking about the biggest contributors to the portfolio and the biggest detractors from the portfolio. Okay, and I can create a separate video and on some of these companies if you guys want, but just to give you a high level understanding of what these holdings are. You can see that the bottom five detractors from the fund's performance in 2025 were Novo Nordisk. Okay, some of my clients also own Novo Nordisk, and they are making a killer because they bought Novo with a significant margin of safety. Bear in mind that Novo continues to be a quality company. Otherwise, Terry Smith would have sold the company, if you ask me. ADP, another company that is high quality, and but these have all been main detractors this year. Okay, Coloplast and Fortnite, and then he explains why he gives us he gives his perspective on each of these holdings, and then you can see the top five contributors to the fund were Google, edex, Philip Morris, Meta, and Microsoft, many of which he has owned for decades. For over a decade. That is certainly the case of Microsoft, which has been a key constituent of his portfolio for over a decade now, and yeah, and the other ones he bought more recently, for example, Alphabet. But again, we continue to apply a simple three-step investment strategy: buy good companies, don't overpay, do nothing. The only thing that I don't agree is with this one: don't overpay, because I think he overpays. Okay, and for example, you can see that's okay if the expectations go, if the company really lives up to expectations, they will become good investments. But the point here is that it doesn't have a margin of safety. Okay, and that's my main criticism of his framework. But over time, it's worked well for him. But it's also true that the last 5 years he has underperformed the major indexes. Okay, let me give you a very quick example. So, for example, just without deviating, you can see, look at that. And by the way, he owns some of the Max 7 stocks. So he owns Meta, he owns Microsoft, and he owns Alphabet. So it's not like he doesn't own any of the Max 7. Okay. So, for example, in my case, the fact that I am clearly trouncing the S&P over the last few years is, I mean, incredible because I don't own any of these overhyped companies. So I don't own any of the Magnificent Seven, but that is certainly not his case. Okay, but you can see, for example, that some companies that he bought that I can create videos on as well. For example, where is that? Right, this one. So you have Walter's Clover, some of but you also have Zoetis. And Zoetis, so they sold or bought Zoetis? No, they actually bought them. Okay, and if I go, Zoetis has come down under pressure recently due to some industry headwinds, but it's still a good company. Um, but there are other companies, for example, and if you look at the valuation at some of these companies, for example, Walter Clower, you can see the PE is around 18 times, which is not too bad, but he has no problem. But in fact, he buys, or very often he buys companies with PEs over like around 23, 24. To me, that's overpaying. Okay, that's just my humble opinion. But yeah, it's what it is. And look at the fundamentals of his portfolio, so you can see that in fact, let's go back to our sheet right here, to our Word documents. So that's the framework. Now it says portfolio fundamentals remain strong. Portfolio companies are older, proven businesses. Average from the founding period is around 1990. Okay, which is incredible. So like a century year old. Over a century year old. Growing free cash flow faster than long-term averages, which is something that he pays a lot of attention to. The free cash flow growth of his holdings. The only weak spot, as he mentions, is the cash conversion. So cash conversion, as you can see right here, look at that. The cash in 2025, the cash conversion of his portfolio was around 94%, and that was excuse me, let me have a look here. So we have cash conversion about 94%. Okay, so look, cash conversion was around 94%, which is higher than the S&P 500 89%, but lower than the FTSE's 100. Okay, and you can see that, for example, other metrics like ROS, return on capital employed, is greatly above both the S&P 500 and the FTSE's. Same thing with gross margin and operating margin. Okay, and in the interest coverage is also much greater than the S&P 500 and the FTSE's. Okay, interest coverage is how well the company can pay can meet payments on the interest payments relative to the operating income. Okay, so very very good. The higher the better. Okay, and with regards to cash conversion, it tells you how effectively, how quickly the company can convert profits into actual cash. And the reason for this decline, so the reason that, not decline, the reason this has been lagging the FTSE's is because all the capex that some of his largest allocations have been embarking on, this is due to massive AI related capex at Alphabet, Microsoft, Meta, and Amazon. Okay, very very important. But what I also noticed is, look what happened to Royce. So in 2025 it was 31, which is very good. Okay, above average, I would say. Gross margin 62, very good as well. The operating margin is at 28, also in line with the records going back to 2018. So it's quite good, right? Even interest coverage also went higher. So the fundamentals look very good. It's just a matter of how much you are paying for the companies in your portfolio. And AI caps arms race. Huge spending raises a key unanswered question. Will returns justify the capital invested? Apple stands out by largely opting out, much lower capex, focus on devices, ecosystem, and services, may benefit from AI without bearing infrastructure costs. Let's have a look here what he says about this. Right here, one company which intrigues us in this respect is Apple. Depending upon your point of view, it has either been left behind okay, in the scramble to build large LLMs and hyperscale to provide AI infrastructure, or it has opted out of the race. As a result, its capital expenditure in 2025 was a mere 12 billion, which pales in comparison to the capex to the expected capex for the other hyperscalers. Look at that. You can see that in 2025, in 2026, look at the expected capex investments. That's staggering. Okay, it may be making a virtue of necessity, but maybe Tim Cook, the CEO, is working on an old adage. You don't have to own a cow to sell milk. Apple has its devices and about a billion, mostly high-end consumers locked into them. Very strong moat, as we all know, and increasingly into its services. It seems unlikely that there will be a shortage of LLMs that the hyperscalers will want to offer Apple for iPhone users. Fantastic. It is indeed the business model Apple is relying on. It may not bode well for the LLM developers and hyperscalers' profitability. So the second, what he's saying right here is that it remains to be seen whether all these investments in AI-related products and services will bear fruit down the line. Okay, it remains to be seen. We just don't know. We don't know if these investments will turn into actual profits. What's the bottom line for investors? He believes markets are currently driven by momentum, index flows, and narratives. Fundamentals will eventually reassert themselves. This is important. Fundamentals will eventually reassert themselves. Over time, so in the short term, the market is a voting machine. In the long term, the market is a waiting machine. And that's it. Short term underperformance is painful indeed, especially when it's already several years long, but abandoning discipline at market extremes is far more dangerous. So this is a guy who sticks to his guns. Sooner or later, share prices reflect fundamentals and not the other way around. Okay? So I don't think, and you can see, for example, it uses the free cash flow yield to determine how expensive or cheap his portfolio is. The free cash flow has come down, but because the hyperscalers have been using free cash flows with the free cash flow to grow, which gives the impression of depressed free cash flow, but that really understates the potential that understates the real free cash flow power of these companies, right? Because they are purposely reinvesting into the business. That's it, guys. I mean, I think these are the main highlights right here. Then he talks about the companies that he just bought. They include Walters Kluwer. Sorry if I'm mispronouncing it. Also, he bought a stake in Intuit, another very quality company, and in Zoetis as well. And he sold his holdings in Brown and Forman and PepsiCo, and he's still holding on to his Novo Nordisk investments. Okay. This is the main highlights from the report. I think it's very telling, and I think I really hope it managed to drive home the idea that when you have a sound framework, just stick to it and don't fall into hype. Don't get caught up in all the speculative moves that you see all the investors make, because over time what matters will be the fundamentals, and it's preferable to actually underperform over 2 or 3 year periods, but then have a great track record over 15 or 20 years than to fall victim to these speculative moves and ruin your portfolio returns over time. Okay, it will take you many years then to come back to break even. All right. Let me know in the comments if you like me to explore more his report. Especially if you want me to delve deeper into some of the companies he sold in his portfolio holdings. So let me know in the comments if you like this video, and stay tuned for more, guys. Have a great day.